All right, welcome again, everybody. I'm Dr. Lisa Sturtevant, Chief Economist with Bright MLS, and this is our monthly webinar on the housing market. This webinar is recorded. I'll begin recording now. Thank you for attending today. Each month here at Bright, we come to you with information on the housing market and the economy. And today we want to share a little bit of information about where we are in the spring market and where we might be headed. As always, if you have questions, you can use the Q&A feature at the bottom of the webinar screen, and we'll try and do our best to answer questions as we go along. Today, I'm really excited to be joined by our senior economist, Erica Plemmons, and she and I are going to present a little bit of information and go through some of the key trends we're seeing in both the economy and the Mid-Atlantic housing market, and then offer some thoughts for where we might be headed as we move into the summer. So let's get started. Erica, if we take a look at the next slide, where are things in terms of the economy? And on the next slide, there's a few different things we want to look at as we're thinking about how the economy is doing. And if you've been paying attention at all to the news, you know there's a lot of uncertainty out there. There's a lot of different information. And there's a lot of different things that are happening in the economy that could affect the trajectory of our housing market. And so I'm going to cover a few things that I think it's important for us to be watching as we're trying to gauge where the housing market's going to head in 2023. So in the next slide, let's talk first about inflation. We've been talking about inflation a lot for the last several months. The dark blue line on this chart is the overall inflation rate. And so you can see back in the summer of 2022, inflation peaked at about 9%. And we've seen inflation steadily come down over the last few months. But the last measure that we got in April still shows that inflation is running higher than the Federal Reserve's target rate of 2%. And so there's a lot of uncertainty about what the Federal Reserve might do since inflation is still running higher than they would like. But at the same time, there's still a lot of uncertainty in the banking sector. There's a lot of questions about whether the labor market is softening. And I'll add one more thing. I think it's important for us to remember how important housing is to measures of inflation. And the light blue line on this chart is a measure of housing costs. And if you'll notice, if you look in the middle of the chart back during the financial crisis, if you notice, the light blue line is what I'm calling shelter CPI. And there's a great question I should have clarified. CPI stands for Consumer Price Index, and inflation is actually a measure of the change in that Consumer Price Index. So overall CPI is the line we're going to look at for overall inflation. And shelter CPI is a measure of how fast housing costs are growing. And so you can see that light blue line is still climbing, but as most of us know, home price growth has certainly moderated, rent growth has moderated, and so that shelter portion of CPI is actually lagging. I mean, it takes several months for moderating housing costs to show up in lower inflation. So I expect that we'll continue to see inflation come down, particularly as that shelter component, which accounts for between 30 and 40% of inflation, particularly as that shelter component continues to come down as we see the housing market sort of reset. If we go to the next slide, we talked a little bit about inflation and about how the Federal Reserve reacts to inflation. And the main tool the Fed has used has been to raise the federal funds rate. So if you click once, you can see this period, right, during the pandemic where the Federal Reserve began to raise the federal funds rate. That's that light orange line. And while the Federal Reserve doesn't specifically target mortgage rates, we know that mortgage rates tend to move up when the federal funds rate moves up. But look what's happened here over the last few months. Mortgage rates, this is the 30-year fixed rate mortgage, an average on a 30-year fixed rate mortgage. You can see that the average has sort of hovered between 6 and 6.5%. With inflation still high, there's a little uncertainty about what the Federal Reserve is going to do. Some people are saying the Federal Reserve is going to pause rate hikes. Other people have said that the Fed is going to actually cut rates later this year. My guess is that we will see a pause in Federal Reserve interest rate hikes, but it's unlikely for them to begin cutting rates in 2023. So that means that mortgage rates will likely stay in the 6 to 6.5% range for the foreseeable future, and certainly through the second and third quarter of 2023. On the next slide, we'll take a look at where mortgage rates have been historically, because as we know, rates have risen really quickly over the last year. But if you put today's rates in historical context, you can see that compared to where we were in the 90s, in the early 2000s, we're still about at between 6 and 6.5 is about where we were between 2000 and 2010. So while rates have been lower over the last decade, and certainly much lower over the last few years, compared to long-term averages, we're still sort of right in that range where we have been over the last few decades. If we go on the next slide, we can look at the labor market, because that's the other piece of this, right? When mortgage rates are higher, buyers pull back, sellers also pull back because it makes it more difficult to buy and sell a home. On the flip side, though, when the labor market is strong, we also know that home buying demand increases. And in our market, and really in most markets across the United States, labor market conditions have been surprisingly resilient. This is the unemployment rate for the US, as well as for the 3 major metro areas here in the Mid-Atlantic. The US unemployment rate is at a 50-year low, and similarly in our main regions, you can see that we are back down to pre-pandemic levels. It's a very tight labor market, wages are still rising, and so far those Federal Reserve rate hikes haven't softened the labor market. But on the next slide, you can see there may be some signs that we are seeing a bit of a cooling. If you squint just a little bit, the bars show the number of new jobs added to the overall economy every month. And you can see those bars maybe are getting a little bit smaller as we head into March and April of this year. Similarly, the dashed line shows the number of job openings that come available each month. And for the last few months, we've actually seen fewer job openings in one month compared to the month before. And so that does mean perhaps that employers are being a little bit more cautious, and that the labor market might be slowing down just a little bit. It also means, though, to me, that if we are headed towards a recession, we are still very unlikely to see a major recession in the labor market, simply because conditions are still really, really tight in terms of unemployment and also in terms of job openings. The last thing to mention on the next slide, and I know you guys have been hearing a lot about this, is the discussions and the debates and the negotiations that are happening in Washington around the debt ceiling. The debt limit is set at the limit at which the federal government can borrow, and we actually hit the debt limit back in January. Since then, the federal government has been using, let's call it creative accounting measures, in order to avoid exceeding that limit on how much debt the federal government can carry. But soon, very soon, we'll be hitting that debt limit, and it will mean that the federal government will have to stop making payments. Will stop paying their bills, stop sending out Social Security checks, stop writing payroll checks to federal government employees, stop sending money to programs that are supported with federal funds. And we could see very quickly mortgage rates spike. We could see really difficult economic impacts. It is unprecedented. We have never defaulted on any of our obligations as a country, and it is very unlikely that we'll do so this time around. But all of this conversation, all of this negotiation has really raised a lot of uncertainty and is adding to this decline in consumer confidence, and frankly, this sort of wait and see approach that many people are taking now when it comes to making big decisions, including buying or selling a home. So on the last slide, on the economy here, just to sort of summarize, I think inflation is coming down, and that's a good sign. Interest rates are probably going to stay around where they are currently, at least for the short term, into the second and third quarter of 2023. And the Federal Reserve probably won't cut rates in 2023 unless we take a really radical turn in the economy, the labor market is still resilient, and this debt ceiling discussion is really causing more uncertainty, which is leading to one of the reasons why we're experiencing a sort of slower than typical spring housing market. And with that, I'm going to turn it over to Erica to talk a little bit about where we are in the housing market, looking at trends in sales and prices, and then also to take a little bit of a look ahead to see what the summer market might hold for us. So Erica, I'm going to turn it over to you.
Thanks, Lisa. So as Lisa, let me get my drink first. So as Lisa shared, we have an economic background that has a lot of economic uncertainty. And that means for buyers and sellers, they're going to be very cautious. So what's happened so far with 2023 market activity? Starting with new pending sales, we're going to focus on the orange line, which represents 2023. And what you can see is there are gradual market gains in each month. But unlike past springs, these gains aren't showing the spring-like uptick, the spring bounce that we expect when homeowners are in peak shopping mode. If we focus on 2023 compared to the prior 2 years, it's unsurprising that new pending sales are lower. Now, the interest rates are much different than they were in the past 2 years. But if we also look at 2023 compared to 2018 and 2019, it's also lower. We're going to be using 2018 and 2019 as our benchmark years because housing reacted typically then. There was a spring buying season. There was good activity levels. So the fact that we're lower now is due to a variety of reasons. The economic uncertainty that we're seeing, in the headlines, you see there are announcements of layoffs in the tech sector. There are the banking failure. There's discussion of the debt ceiling, as Lisa showed on the chart. Those are all factors that are going to cause buyers to pause. But buyers are only one part of the equation showing lower activity. But moving from pending sales, we hope that once a sale goes pending, it moves into closed status. Usually it takes 30 to 60 days for a home to go from pending to close. But unlike pending sales, we're seeing a little bit of a different trend in closed sales. While pending sales have grown the past several months, which should lead to growing closed sales in April were actually a little bit lower than March. Now, this could be that these pending sales that happened in prior months are just going to show up in May, or it could be that some of these contracts have fallen through. Lisa and I are hoping to work with our data science team to better get a picture of how listings are coming on and off the market. And once we have any findings, we're going to share them in a future subscriber webinar. But what we know is if you take that anomaly of 2020 out of the equation, the activity that is happening this spring buying season is not matching what was typical in the past. The other thing that we've seen changing is prices. Over the past 2 years, there's been double-digit growth in prices year over year, and that definitely wasn't sustainable. In April of 2022, although it looks even in this chart, the median sale price was $381,100. And that is actually slightly above what we're seeing for this year, which is $380,974. So this is our first year-over-year decline in over 86 months. So that is 7 years of year-over-year price growth that is now changing. But the median price I'm sharing here is for the entire Mid-Atlantic region. And as we know, real estate is local. So let's focus on 3 of the major metros within the region. So if we look, focusing on March 1st for Baltimore, which is the orange line, and Washington, D.C., which is the light blue, you'll see that median price was negative year over year in March. But then as we got to April, it's flat growth for the Baltimore metro, And Washington, D.C. is still showing the median sale price being negative year over year. It's the third month in 2023 that the Washington, D.C. Metro has reported a decline in year over year prices. Philadelphia, on the other hand, shows still rising prices, but the price growth is modest, up 1.2%. But if you're attending this webinar and none of these metros are your business area, you may be wondering, well, what about me? If you haven't checked out the market reports for April 2023, I encourage you to go to the Bright website, because now there are monthly market reports for all 9 metro areas. Let's take a quick glance at what all 9 MMAs are saying about prices. So as we saw on the last slide, there were declines in the Washington, D.C. area. It's relatively flat in Baltimore and North Central Virginia, and the other metros are showing modest increases in price. This is 1 month of data. So those that are showing increases for April may have shown flatness, increases, or even decreases that month. So I'd encourage you to check out your reports. But I want to stop for a second and describe what a median is. The median represents the middle property. So if you have 5 homes that sell, if you put them in ascending order, that middle number becomes your median. So the median can fluctuate due to the composition of homes that are selling at a time. One way that we can look at true price appreciation is by looking at an index. And so on this slide, this is the Case-Shiller Price Index for the national picture. How the index works is that homes are grouped. Pretend that you sold a home in 2015 and you sold that home again in 2021. That is one sales pair. And with all these pairs together, they mash them up and they create an index value that shows how prices have appreciated over time. January 2000 is our 100 value. And then if you compare the other values, you can see how prices have changed. The peak in prices was hit mid-2022, and prices have been negative month over month. But that's not the case when we look year over year. If we focus on the more current time frame and we look at 2023, unfortunately, with Case-Shiller, the data is quite lagged, and we only have through February. March's data will be available on May 30th. So what we have through February still shows price gains year over year on the home. So just because the median may be negative or positive, that may not be true for price appreciation. And I'm sure you're seeing it with individual homes. There are going to be some that are in still very hot local markets that they're going to be getting increasing prices from the past. And bringing this into the Bright MLS area, Case-Shiller does do an index for 20 cities across the nation, one of which is the Washington, D.C. Metro. And you can see, similar to the nation as a whole, prices are lower than their peak, but they are still growing when we compare to the prior year. Now we're going to have to wait and see what happens with the March and April price appreciation data. But as you saw with the median price, we're seeing some flatness, and it could be up, it could be down. So we're going to wait for that information. The important point, though, with the price appreciation that I want everyone to remember is look at how the bars have changed. The bars have grown through the end of 2020 through 2022. But as they have gone down, they've gone down in gradual steps. There's not some big drop off in price. Many people are wondering, are we in a period that's going to be similar to 2008? And this doesn't look like that. The one big difference between that and now, and there are several differences, but the one that's easy to see is the difference in active listings. So let's start with actually 2022, which is that gold line. It crossed the silver line representing 2021 in May. And that was the first time that active listings weren't decreasing in the Bright MLS area. So the line continued to be above for the rest of the year. And as we got to 2023, it was higher than both 2021 and 2022. But it's actually really close. And although we are, happy to have more listings on the market for our buyers, in the scheme of things, inventory is very constrained. Comparing it to that benchmark, so we're going to go with April of 2019, the active listings on the market today are only 43% of what was available then. So for buyers in the market, it's going to be tight because there aren't many homes to choose from. We don't see that changing anytime soon based on the new listing information we're seeing. We know buyers are hesitating, and so are sellers. They've locked in great rates, whether they purchased or refinanced. They may have bought a home that they, met all their needs. They may just be like buyers, also just watching to see what happens before they make a big move. And with new listings being low and therefore active listings also probably going to stay low, competition will be fierce. Many homes in the Mid-Atlantic are selling very quickly. So buyers must compete for this limited supply. The median days on market has declined seasonally as we saw in prior years. But whether it stays this low because supply is constrained, or it starts edging upward because demand is less than the past and activity overall is slow, is yet to be seen. So we're kind of in this paradox. Closed sales, pending sales, new listings, they're all showing us that market activity isn't what it was in the past. It's slower. But when we consider an individual buyer or seller, their transaction could be happening still in a matter of days and weeks. And because there's limited inventory, prices are holding firm and are feeling elevated for buyers. One of the things that has corroborated this competition is our subscriber survey. This is the third month we've done it. And if any of you in this webinar participated, I want to say thank you so much. We're finding great insights through your answers that are not available through the listing information. So to start off, one of the things that we looked at is the number of offers a buyer typically made before they were successful. And on average, that was 2.6 offers. So if you add up these percentages, those two or higher, about 3 in 5 buyers have to place an offer on more than one home before they are successful in a purchase. And this varies dependent on the type of buyer. For first-time home buyers, it's a lot less likely that they're going to win on their first offer. Only 1 in 3 were successful that way. And first-time and repeat buyers are experiencing very different markets. For first-time home buyers, they're most likely going to need to use some sort of financing, whether that's a conventional mortgage, FHA, VA, etc. But repeat buyers may be able to tap into equity in their home. They could have extra savings, and they're able to put that towards a home purchase and make a more competitive offer. Looking at the price ranges that first-time home buyers versus repeat buyers are trying to compete in, you can see over 80% are focused below $500,000. And so since there's limited homes in this price category, they're more likely to face competition not only from other first-time buyers and repeat buyers, but investors. Now, the other thing I wanted to point out that was very interesting to me from the survey was the length of the home search. Most of these bars look pretty similar. You can see a difference in that less than 1 month, but also in the 3 to 6 month, it meant 1 in 3 first-time buyers took that long to search and successfully purchase a home. But that wasn't the cool thing to me. If we focus on those first 2 groupings of bars, 47% of the buyer agents that we surveyed said that their buyer had been searching for 2 months or less. We're hearing that demand is lower, but demand is still occurring because these buyers are joining the market now or recently, as opposed to someone who's been searching for over a year. So we know that there's still demand as people are joining the market, but where are they going to find the home? And for that, we're hoping that there will be new listings. According to those listing agents, the primary reason for selling is for family reasons. This could be marriage, divorce, having children and needing a bigger home. Those are some of the things that are never going to stop. Everyone is going to continually have life changes that may impact the type of house that is right for them during that time. But the second reason that we saw was selling a rental or a vacation or a rental or investment property. So that's another source of leads that you may be interested in tapping, finding out whether the person is renting the home. They may be looking at this as a good time to sell and cash out. With that, let's look at what's going to happen in the future, or what at least we're expecting. Before we tell you what we're thinking for 2023, I want to share what you shared through the subscriber survey. And what we're seeing is that most are expecting buyer activity to be high to very high or even average. And on the seller side, agents are expecting seller activity to be low to very low. And there was a change from April to May. The amount of agents that said high to very high dropped, and the agents that said low to very low seller activity increased, which shows less optimism about our summer market. And to close, what does this mean? What can you take back to your different clients? For buyers, we're expecting rates in the 6 to 6.5% range. Even though rates seem relatively stable, it's important for buyers to shop around. Loan rates and terms will vary, and you need to use your connections to help your buyers find that best rate, because that could save them hundreds of dollars a month on their mortgage payment. While competition is fierce, you know your local market. There are some areas that maybe aren't as competitive, and there have been homes that are sitting on the market, and you can help your buyer negotiate on price and concessions. But again, there are some places that are going to stay very hot and competitive for buyers, especially when they're competing against cash buyers. Inventory will remain low, and we don't see, at least based on our current new listings data, that will change in the near future. So buyers who do find that home that they want need to be able to pull the trigger quickly. If you're working with sellers, as we saw through our survey, there's still strong interest from buyers, and activity is expected to be at least average, if not higher, very high. But if you want to sell your home in a certain time frame, you need to price it to this market, not the market of last year. You should take the time to work with your sellers to prep their home so that they can advertise it and get the best offer available, and possibly multiple offers, as that's another thing that we learned through our subscriber survey. You need to advise sellers that although the market is still competitive, that they should prepare for negotiations, because buyers today aren't necessarily the same buyers in the past, and they're not going to have 20 or more offers on a single home like we saw in 2021 and 2022. And one of the things buyers, especially first-time buyers, may need is closing cost assistance. For agents and brokers, it is your job to be the expert in your area. We hope that you will tap into Bright's resources in order to understand more about the market, but you also need to continue to read the headlines and understand what everyone is saying, because sometimes what they're sharing is true, and sometimes there are myths that then you're going to have to work out with your buyers and sellers and show them the facts about the market. With that in mind, resources are available on brightmls.com/research. We publish weekly reports and monthly reports. And as a reminder, go to the website. There are now reports for all 9 metro areas, as well as the Bright footprint overall. And this has data and market commentary that you can use to be educated about your area. We have blogs in our news and insight section, and like you're attending today, there's our subscriber webinar. We encourage you to use our home demand index, and please, if you would get a subscriber survey in the future, consider filling it out. It will only take a few minutes of your time. So I'm Erica Plemmons. I'm the senior economist at Bright, and Lisa is our chief economist. If you have questions, we'd encourage you to reach out, and thank you for joining us today for the webinar. I see some hands raised.
Yeah, thanks, Erica. There's a couple of questions about the areas on which we're reporting. So note that yay, now Southern Maryland finally has stats. So we're happy to be able to provide that information. If there are areas that you're looking for that you can't find, please do let us know. Was there a question? If you have a question, it's probably easiest if you put it in the Q&A box down at the bottom. And that way we can sort of make sure that we get that in the queue and have a chance to review the question. This presentation and a recording of this webinar will be available on the Bright MLS website. Look for it tomorrow. And then again, if you have other questions, please don't hesitate to reach out. There's a question here from Richard about an update on new construction. And Eric, I'll take that one to start. We have seen that new construction has been steadily increasing over the last few months. And in fact, at the national level, we've seen that new construction as a share of the overall inventory available for sale is at the highest level that it's been in quite some time. And so I think what we're seeing is that builders are seeing strong homebuyer demand, seeing very low inventory of existing homes for sale, and we have seen that that new construction has increased. Some of the supply chain issues that plagued new construction during the pandemic have eased up, but builders are still finding that it is challenging to find labor, to get materials, and to get approvals to build sufficient housing at the local level. Here in our area, we've seen some markets where new construction has really continued to boom, including some markets in Sussex County, Delaware, and other parts of Delaware. We've seen a lot of multifamily construction in some of our closer in and urban markets in the Philadelphia, Baltimore, and DC areas. And I think we should continue to expect new construction to remain on the upswing as we head through the summer.
Yeah, Lisa, I'll just chime in to add, I recently read a John Burns real estate consulting survey. And in November, when they polled the builders, most were anticipating slower sales and lower sales in 2023 than the past year. And as of their April survey, the trend has completely reversed and builders are showing optimism. And almost in all regions, they're expecting sales to be higher than in the past year because of, such low inventory on the existing home side.
Great. We have another question here about the graph showing the rise in prices going back to before the last downturn is troubling. It shows the increase in prices this cycle is longer and more pronounced than the last market cycle. Does that cause concern for you? So, I'll take this question. I think that we have been seeing home prices rising, as you point out, for quite a long time. We do have to remember we're coming from a pretty dramatic downturn after the 2008 financial crisis. And in fact, there's some markets in our Mid-Atlantic market that only just recently found home prices back up to where they were prior to the housing market crash of 2008. And so while we have seen a much longer run up in home prices, we actually it's in a very unusual cycle. I think what's more concerning to me, if I had to pick out a point of concern, is that we have been seeing home prices rise faster than incomes really for the last couple of decades. And that rising unaffordability is something that's been characterizing the housing market really since the 1990s, if not before. And the solution really is to increase the amount of housing that's available, both for rent and for sale, Because as we know from estimates from Fannie Mae and from NAR, we're between 3.8 and 6 million housing units short of what is needed to meet demand nationally. And that's the primary reason why we've been seeing home price growth for as long as we have. Well, I want to thank you all very much for joining, and look forward to then seeing you next month. Take care.